Thanks for joining me for this video presentation. My name is Sean Silbert, and I'm going to be covering Topic 2, a summary of the course content progression thus far. We've covered 2 units and 8 chapters in this class so far: managerial accounting concepts and principles, job order costing, process costing, activity-based costing, cost behavior and cost volume profit analysis, variable costing, master budgets and performance planning, and flexible budgets and standard costs. In Chapter 14, we learned about the purpose and nature of, and the role of ethics in managerial accounting. It provides useful information to management and other decision makers. Major characteristics are a focus on internal decision makers, emphasis on planning and control, flexibility and timeliness, reliance on forecasts and estimates, and reporting monetary and non-monetary information. Ethics play an important role in reducing fraud. We also learned about some cost classifications as well: fixed versus variable, direct versus indirect, and product versus period. Some trends in managerial accounting are increased focus on customer satisfaction and a focus on the impact of the global economy. In chapters 15 and 16, we look at the 2 basic types of cost accounting systems. In job order costing, the products are custom, produced in small quantities, costs are tracked by the job, and cost per unit is measured upon the completion of the job. In process costing, the products are identical, produced in large quantities, costs are tracked by batch of goods by department, and cost per unit is measured at the end of the period. In Chapter 17, we learned that activity-based costing uses multiple overhead allocation rates based on activities, provides more accurate overhead cost allocation, more effective overhead cost control, focuses on relevant factors, and provides better management of activities. So how does each chapter's content in Unit 1 fit into the next? Well, Chapter 14 leads into Chapters 15 and 16 through a clear understanding of how we classify costs and well-defined goals of managerial accounting that we're striving towards. Job order and process costing also show us the 2 basic costing methods to achieve these primary goals that were defined in Chapter 14. And Chapter 17 relies on the information from Chapters 15 and 16 to give us a contrast to show why activity-based costing is so effective and accurate. Chapter 18 includes topics such as different types of cost behavior, including fixed costs, variable costs, mixed costs, stepwise costs, and curvilinear costs, and applications of CVP analysis, which predict what can happen under different strategies, the contribution margin, which is the amount of cash received that contributes towards fixed costs and income, the degree of operating leverage, which determines the expected change in income given a change in sales, and the break-even point, sales volume at which total revenues equals total costs. Chapter 19 introduces us to the concepts of absorption costing and variable costing, how they differ in how fixed costs are allocated, cost per unit, and their income statements. This chapter talks about converting income between costing methods and determining product selling prices and markups using absorption costing. Chapter 20 is about master budgets and performance planning. The benefits of budgeting include planning and management analysis, the basis for evaluating performance, coordinating activities, and internal communication. 3 aspects of budget administration are the budget committee, budget reporting, and budget timing. The master budget, formal overall plan for a company, consists of plans for business operations and capital expenditures plus the financial results of those activities. The operating budgets are the sales, production, manufacturing, and selling and general administrative expense budgets. Cash budgets show expected cash inflows and outflows, and the budgeted financial statements show the expected financial consequences of planned activities. Chapter 21 is about flexible budgets and standard costs. The standard costs are the normal costs that should be incurred, and they're developed based on careful examination. Variances can be favorable or unfavorable, and they're used to monitor and control activities. Generally, they're broken into price and quantity variances. Flexible budget expresses variable costs in per unit terms, and it computes budgeted amounts for evaluation after a period for the volume that actually occurred. So how does Unit 1's content fit into Unit 2? And how does each chapter's content in Unit 2 fit into the next? Unit 1 gives us a general overview of the goals and basic costing methods of managerial accounting. With this foundation, we can go into more detail in Chapter 18 with the varying ways costs behave, such as mixed, stepwise, and curvilinear costs, and developing a cost volume profit analysis to predict and prepare for varying future sales volumes, selling prices, and costs. Having established more thorough classifications of costs in Chapter 18, we can begin to understand the differences between absorption and variable costing and how to use these methods. With a thorough understanding of costing from the previous chapters, we can lay the groundwork for an understanding of budgeting and the various budgeting documents. And lastly, with a basic understanding of budgeting, we can look at budgeting in more detail with flexible budgets and standard costs in Chapter 21.